Emerging market bonds have certain bond-like characteristics and equity-like characteristics. So when I say bond-like characteristics, like an Australian government bond or a US Treasury, they are promising the repayment of principal for capital preservation along with a particular coupon or yield, which in the case of emerging market bonds offers a higher yield than Australian government bonds or developed country bonds. So there's that sort of income stream similarity to bonds, yet because they are emerging market investments and they're subject to the credit premium that an investor receives from lending to emerging market governments, and also potential for currency appreciation in the case of local currency bonds, they can tend to go up in value during periods of time when equities go up. And so because they have some of these bond-like and equity-like characteristics, they can be a nice complement to reducing risk if you're replacing equities, or increasing return if you're replacing traditional bonds. Well, I mean, I think the important thing about thinking about retirement income is the income side of it. And when you own a bond, then you are receiving a stream of income of debt service from the emerging market government or corporation that you're lending to. And I think it's important to say, emerging market has a very different connotation than it had when we were discussing this 15 years ago. In the 1990s, emerging markets had much higher levels of debt, were borrowing from developed countries. Now the situation is entirely the reverse. It's emerging market governments that are actually the creditors in the global economy, have built up large war chests of foreign reserves that provide plenty of resources for servicing that debt. So one important reason for thinking about emerging market bonds for retirement income is because of this income component. The other component is just this volatility component. Retirees should be particularly concerned about the volatility profile of their investments. And so again, emerging market bonds have more volatility than traditional bonds, but substantially less volatility than equities. And therefore, from a portfolio construction point of view, you can optimize a position on an efficient frontier by using emerging market bonds as one of the tools in the toolkit. I think that planners here in Australia and planners and pension funds here in Australia are very sensitive to how to generate returns in a low interest rate environment without taking excessive risk. And that's why there's increasing discussion about the role that emerging market bonds can play in Australian portfolios. Incidentally, that mirrors the discussion that's taking place in other places in the world. Some of the early adopters in global asset markets tend to be sovereign wealth funds. And we've seen sovereign wealth funds increasingly redeploying capital from developed market investments into emerging market investments. And I think that the same issues that Australian planners, Australian investors, Australian pension funds are discussing, the reason that they're contemplating emerging market investments mirrors what we're seeing in other parts of the globe.